So I'm here with another update for all of you, and let's see what the equity markets are telling us today and what my insights, what my expectations are for the third and fourth quarter potentially of this year. So I'm recording this market update as of the 12th of June, just so you know, in case you look at this at a later stage. Let me just minimize myself a little bit. All right. So, as you know, I have been really bullish all the way through the bottoms that we have seen in 2022. When everyone was talking about recession, I said, guys, we're going up. My first take profit target is 5,600, and my second take profit target is 6130 on the SPX. And as you can see, we actually made it exactly within 50 basis points of that target. And there I actually scaled out over 80%. I actually sold nearly everything, as good as everything myself. And I recommended to others at least take 80% profit. And yeah, that was a really good 2.0 Fibonacci level that we reached. And the market reaction after that was quite severe. We did not end up rolling over into a recession, which was my main expectation at the time, because data deterioration was just not that bad. I expect more upside. So that part of my anticipation did not come to fruition just yet. But we did see a big sustainable dip of roughly 20% plus, which I did announce is what I'm looking at the very least. When we hit those lower levels at the start of April, I made a post where I said, like, there is nothing structurally going on. The markets are actually looking really well. And I'm not seeing a recession right now, but there could be a rollover after a bounce. And basically, I remained bullish. I expected a strong bounce back to the upside of 5,800 or so at the very least before we made a double dip and we saw deterioration. But the opposite happened, and I actually flipped back more bullishly a while later, 2 weeks. And I am still more bullish than I was when I took profit around the start of the year, around February, March. So far we have been doing really well since 2022. We've been very spot on with the calls. So what happened so far is we saw a 0.5 touch of the Fibonacci level all the way back down to 4,820, which is basically something that even happens in bull markets. You go up and you retrace up to 50% of that move. And that's just what happened on basically very poor sentiment. Because there was a lot of fear for tariffs, a lot of justified fear, but it was just that. So let's take a look at the January barometer, because this has been tracking really well. So if we look at the start of the year, then we see that we could see a minor new high, which we did. It actually hit our take profit too, where I scaled out. And then it pointed to a new low potentially. That new low occurred in the start of March, but we also broke through structurally in a, let's say, a panic move in roughly 1 to 2 weeks. We touched the 200 moving average, and then we went to the 50% support line, where I also mentioned we have strong resistance, or better said, strong support at that support line. We also touched the 50% FIP line, which occurs very often. We have a spike in volume, which is also an indication of a market bottom or peak. As you can see, our previous bottoming structure also had in August a volume peak. So I flipped really bullish. Shortly after, we saw market structure, a double bottom form. It got confirmed. We broke back above in the moving average band, which I'm tracking. We got back into the bull support, and we've been grinding upwards back into our range of 62 to, I think, roughly 5,900 or so. So we're doing really well. And I've said to you guys as well, I'm scaling back in. The barometer has been spot on. As you can see on the barometer, you also see a double bottom and then a retest into new all-time highs. And that is basically what I'm expecting. So new all-time highs are projected to September or October. I'm expecting newer highs towards the end of Q3. And I think that this year the January barometer will be very spot on. It does not happen every year, so it's not like a golden rule, but this year it has been tracking really well. I'm expecting we could see new highs. What height am I looking at? I'm basically looking at the 2.0 Fibonacci line as a maximum target, which would imply we could see roughly 7,000 on the SPX before year end. That is my expectation. And that could happen as soon as the end of Q3 or depending how things develop and track, it could even roll over into Q4, but I'm expecting that price to be hit this year. So equities are looking rather good structurally. We had a big retracement of 20%. It doesn't happen every day, so yeah, it's looking really, really well. Let's look at earnings. The earnings we have had so far are really solid. I mean, we've beaten estimates time over time. We're now in the second quarter, so we only have earnings for the first quarter, but second quarter is looking well as well. 80% has beaten rather the estimates with an upside surprise, which is also really strong. So earnings are doing well. We had negative GDP in Q1, which was a big concern because I was also concerned about the potential cuts coming from the efforts of Elon Musk with the Doge program. But the Doge program basically, it failed. They cut 150 billion so far, which is like 1/8 of what Musk was calling for. So the impact is very limited. We had negative GDP because of tariff fears. They pulled forward inventory, so net imports turned negative, which had a big effect on GDP because it's 70% are imports. But now we see the reverse actually going on for Q2. The estimates are actually extremely bullish. We're going for 5% coming out of negative. And that's because we're seeing the opposite of that trade unwinding. So first you see an overly pessimistic view. Now we're seeing an overly positive view. But we're back to normalization, which is really good. If I move my head a little bit, you can see inflation as well from Trueflation. We went up into the start of the year together with asset prices, but then saw another big drop. And yeah, inflation is not the problem. We trended all the way down around 1.2%. And we are still seeing inflation in a downtrend. So that's also bullish. That's also very good. Now, there are people who are talking about concerns with the tariffs, etc., but those are not risks, which I'm discussing right now because we're looking at the third and fourth quarter. So if you look at seasonality, we basically see the same left upper corner. It's basically flat to sideways, slightly up. Which is what we are seeing after our dip. We saw a dip in April and then a good May. That has occurred. Overall, we see a flat June. I think that's basically going to play out the same. A flat June. And then we will see further upside going into the end of Q3. You see seasonality is strong in Q3, and then we see another leg at the end of the year, starting from early October into year end. I can't say if all of it will be upwards, but I am expecting rather another push to the upside into new all-time highs for equities in Q3 potentially. And if not, then likely in Q4, but most likely I'm looking at the summer period for now. We have another model, seasonality model from Bak on Twitter. He has also some really great content sometimes, and he is basically projecting a similar pattern on his calculations, which is showing a low in April, which we had, so we're tracking that really well, and then a strong Q2 to Q3 at least. So I'm focusing on Q3 mostly now because we're almost there in 2 weeks. So strong Q3 into September, October, which is where I'm also thinking we would see a market peak for equities and potentially for crypto as well. That's basically my guessing. September, October, we will see likely a peak. And seasonality is supporting that as well. Oh, and I forgot to mention that whenever you see a strong May with gains of over 5%, since 1950, which is a lot of market data, it's 70 plus years, then you see an average within 3 months upside with two-thirds, 66% certainty, going all the way to 9%, which basically means upside has the biggest probability. Also looking at when you have a correction, you always see a bounce, and this bounce is supported by a lot more. So data is actually looking good. I will talk more about some data which I'm tracking, which is the Fed funds rate. So Fed's fund rate has been lowering. People have been talking about it since 2022 when they said we expect a recession because rates are going up. Well, basically, when rates are going up, you do not see a big dip. You see an initial reaction based on sentiment, based on fear, which we also saw in 2022. We started hiking, which is a purple line. We saw a sell-off, but then we saw new highs. Basically, when rates are heightened, there's a reason for that. Economy remains still solid because otherwise they would not do that, and markets continue to trend upwards. It is when rates are being cut that we see a delay and we see an effect. And if we just look at the 2020 period, which is the previous time a similar cycle occurred, then whenever we have a pause and then we will see a second dip, that is very often when we also see a correction for equities occurring. Because at the time when rates are going higher, there is not a lot of strain on the markets. When they are hiring rates, liquidity is being strained a little bit, is going out of the system, debt is becoming more expensive, and the economic activity basically goes down, eventually with some delay. And then they start cutting as soon as they see that they can cut following the mandate that they follow. But so far, they have paused, and then they had to cut because we had the corona crash and they had to really stimulate the economy, putting liquidity back in. This time is different. I think that, they saw good development, so they put the strain a little lower, provided liquidity in markets. Markets continue to rally higher. We did see another scare with the tariffs, but that's just a news event. Volatility, that's just there. And I personally believe that as long as rates remain flat, that we will continue to grind upwards. And as soon as they start cutting again, and there's talks about September, I was expecting June a while back, but now it looks like maybe September, maybe even later, markets are remaining healthy. Keep in mind, as soon as they are going to cut lower, it's probably because there are issues. I talked about it many times in 2022. Just to keep it short, there are leads and lags. Every time they higher rates, there's a delay. And on average, the delay is 12 to 16 months or 18 months. Before you see the full effect in the economy. It's the same the other way around. So we still have time hovering around. We did not cut too much. I mean, the Fed was too tight, in my opinion. So they lowered it a bit. We're still healthy. We're still hovering flat, which is basically good. I don't know why people are expecting rate cuts, because that is probably because they are expecting QE with those rate cuts. Because if they cut like in 2020, things are going bad. If they cut very fast, very steeply. So people are expecting that, and then they want QE, and then they think asset prices go up. But honestly, I personally think that while rates stay flat, it's actually good right now. Markets are soaring. There is enough liquidity. TGA accounts, RRP accounts, they're providing the markets, and we're seeing upsides. I believe that they will not provide liquidity in the markets that fast. If issues do rise, and we have a chance for that occurring later on in the year, in my opinion, I will talk more about that very soon, then I do think the Fed doesn't want to act like 2020. They will act even slower. There are monetary policy delays, and they will probably be too slow. They will be too slow, as they often are. They often are too slow, and they will be too slow once again. So basically what I expect is, if there is a crack in the economy, they will not print the money. No, they will be hesitant. They saw inflation spike because they injected a lot of money into the world in 2020. They do not want to make the same mistake. Powell has said that 10 times over the past 2-3 years. And I personally believe that, yeah, that's true. He doesn't want to provide QE that fast, which is a trap in itself, because when they have to, because keep in mind, all that leverage is still in the system from 2020, they need to support markets fast, and I think they will be too slow. That's my main concern with rates. But for the rest, yeah, I'm still expecting upside right now, guys. That's the takeaway. Sentiment, yeah, sentiment. Let's first look. Something didn't copy, but this is the typical fear and greed. Normally, you have a gauge. We're currently sitting at roughly 70%. So we're sitting in greed, just below the 75%, which is extreme greed. But if you look, we have been in neutral, which is 50%, or we have been in very big fear, which is below 25% for quite a while. We have been running negative all year long with our correction coming from coming from greed and slightly extreme greed in October. So I do believe there's a lot of space for sentiment to turn. Yeah, we are backing greed, but we are coming from a very extreme situation of extreme sentiment, extreme greed. So a move to the other side, a small sell-off or some consolidation, that's normal. So this is looking rather interesting to me. I think we are going to see a period of greed and extreme greed, the other side of what we have seen the first half of the year. If we look at the lower part, we see the AAIE sentiment, which is also below the averagely bullish at the start of the year. At the start of the month, it's sitting around the low 30s, while the average is 37. So we're not really overheated. I mean, it's not as we were back in 2024, 52%. I mean, we're well around averages, nothing special. But keep in mind, we are around 100 basis points of our all-time high. So that's excellent in terms of conditions for sentiment to have continuation to the upside. NAAEM is also really supportive. I like to include this one because if it dips like extremely low in like, let's say below 40, that is often a nice market dip that we see there as well. And we can see, zooming in on the NIME indicator, if you look back at last year, and I have those numbers because I've been posting about it for years. Looking at last year, going into 2024, coming out of the lows of 2022, we also saw extreme fear. We saw NIME below 20, and in every occasion that it dipped below 40, if you look at the SPX price, it had a sustainable rally higher. So we recently saw another dip below 40. So as I said, at least a strong bounce is what we will get, and that occurred. And I believe that chances are high to see continuation. So yeah, let's talk about my recession indicator, because some really interesting conclusions that I took from it is I like to track the most data that gives a good indication that we are heading into a recession. I like to combine that data, which are basically 12 metrics. I give them a personal score, and you can look on top on what score is good or bad. And when most of the items are scoring negative, which is red, it signals a danger signal. And when that signal gets above 50, which it did at the end of 2024, the next month or 6 weeks after that, we saw our 20% correction. So I'm wondering, like, is this a good gauge to use in the future? Because when it spiked well above 50, which it did here, 58, it was in a clear uptrend, then at least it seems to be showing like, be careful in investing. I mean, invest defensive, diversify, hedge yourself. Don't be crazy, go full long, whatever. because if you see a clear uptrend, that is concerning. And we did see a 20% correction for the first time ever when we had a spike above 50%. You do see that we hit 50% a couple other times, but that was without issues. So far, so good. I mean, we did see our correction, and also at the start of the year, we started declining, going lower. And for now, we are basically potentially going in an opposite trend where we can see the numbers go down, which basically means that we are seeing some kind of yeah, breathing for the market, letting it breathe, letting it move further in a positive manner before we see some potential risks coming again, because we already saw a 20% correction at the start of the year. So the yield curve is not accelerating. Really good. Yield spreads broke out, was a bad signal. It's back to being orange because it's back at the breakout level. It has gone down, which is also good, because if it doesn't retest and break up higher, it could be that it just signaled what has happened, which is good. Overall deterioration at a faster pace is no longer occurring. We are still hovering with the PMIs around 50, which is not that great. Consumers are still weak. That's not great. CPI is red this month, but it's still really low, a lot lower than a year plus ago. Unemployment remains solid, which is also very good. We've been trending sideways for a long while. It has not been accelerating either. I mean, like also the GDP, it turned negative, but now we see the opposite. It was only minor negative, 0.3 on the first revision so far. So there is still overhead concern because, yeah, we still have the positive readings and the Fed funds rate going down. And positive readings for the yield curve, which have a 100% track record, bloody. But right now, the odds are going down. For Q3, for potentially Q4, as long as this indicator is below 50 and not in a clear uptrend any longer, which it has broken at the start of the year, then yeah, I see a lot more probability for consolidation or potential upsides. And for now, we are seeing that. So that's really positive if you stack that with the rest of the data points which I have given to you guys. So what am I looking at? Yeah, markets are forward looking. I mentioned it. And if you look at how equities perform in a recession, if you look from the first month of recession to 1 year after, on average, markets are forward looking, so they trend to move up. We have seen a rejection in markets, a retracement, 50%. Now we are back almost at all-time highs. What is ahead of us? People are looking for rate cuts. Markets are softening. People are bullish because, yeah, bigger size corrections do not occur very often. So, yeah, we are positive. We are actually doing really well. We are seeing upside. And, yeah, people are getting a lot more optimistic once more. And they have a reason too, because on average, markets are forward looking. The Brenner cycle, which I like to track over the years as well, is also pointing to like 25, 26. It's not perfect because, yeah, you can see years in which we have panic. 2019, it's actually 2020, but it started all the way back 100 plus years ago. So yeah, give or take a little, but on average, 25, 26 used to be a good moment, years of good times, high prices, and time to sell stocks and take profit. And that's basically where we are. We are in the year heading into 2026. So around this period, we could see something occur. If you look at the real estate cycles, and very often real estate cycles peak slightly before equities do, then we would also see that we are in a winner's curse, and that we also see a cyclical peak in 2026. So many of those cycles are aligning that we are moving into some kind of cyclical peak. But yeah, we will have to see to what extent we actually have to sell or remain out of markets. And for now, we are still in that upside. We are still in that upside, I believe, and there's reason to remain exposed. Something I wanted to share, which I shared on my X this week, are the long-term cycles. And here we see then I'm looking at the DJI, the Jones versus gold. So basically, if you go back all the way to the 1980s, where we had a peak in rates, then what happened was, so if you are low, just so you know, if you are low on this comparison, then gold is expensive via stocks. So stocks are cheap, gold is expensive. If you are all the way on top, gold is cheap, stocks are expensive. So that's how you read this chart. And this basically tells you how many ounces of gold do you need for one Dow Jones industrial stock. That's basically what it says. So in the peak of rates, stocks were cheap. Then we had a massive greed cycle of the baby boomers. And people really preferred paper assets. We had a fast economic expansion, which basically ended with the dot-com bubble. We then had a period of fear where people preferred hard assets. So we saw a trend all the way up to the great financial crisis, which was the bottom. And we saw our lows right there. Currently, however, I make the case that with this long-term cycle, we are still in a new greed cycle. We are in a greed cycle for the millennials, the new generation after the baby boomers, many of which actually are retiring and basically are out of the market, are no longer active, and they are transferring wealth to the new generation, which is also expanding. And we are seeing some expansion, but we see some slowdown as well. I know some consolidation, which we also saw in the 1940s. If you go to Google and you Google DGI gold ratio, look to the 1940 period, we saw similar consolidation before the rip higher. But I believe that the chances are that we will see a lot of QE in the coming 5 to 10 years at most. That will drive asset prices up, mostly stocks, equities, etc. Because if you just look at where we are, debt to GDP, if you look where we are in the debt cycle, if you look what's happening with interest rates, I do believe we are in a greed cycle for the millennials, and asset prices, they will soar insanely as has happened in the 80s and the 90s. I think we're in a new period like that. And that will be driven by inflation. So we are basically in a greed cycle for stocks. That's what the case I make once again, looking at roughly 100 years of data, zooming in on the past 60 years or 40 years, better said. But take a look on Google for the full chart. And if we overlay this, so here you can see like red and green. And this basically overlaps with the 100-year cycle that I use for basically looking at the cycle of equities. Are we in a bull or bear cycle? If you are in a bear cycle, you do not want to invest in equities. You want to invest in other asset classes that have better performance in those bear market years. But if you are in a secular bull, which is the green, then you want to be exposed. And so far, we are 11 or 12 years into our bull market, which started in 2013. And as you can see, from the 80s all the way to the 2000s, when the Dow Jones gold ratio soared upwards, paper assets also soared to the upside. And this is basically another confirmation of those same cycles. But this time, I only use the S&P price in denominated in US dollars. So I do believe that we are in a period of massive expansion, massive dilution of our fiat currencies as well. Higher inflation generally is coming, but asset prices are still bullish. We are still in our average cycle of 18 years before we see a bear market of roughly 10 years or so. And we are in the last leg of our very long-term 80 to 100-year bull cycle. We are still in that last leg, and that last leg is often the most parabolic because that is where there are, let's say, many issues with debt accumulation in general, where they print so much money, they devalue your money so much, as we have seen in Corona, and that basically drives up asset prices a lot. So basically, What are my conclusions, expectations for the coming months? Heading into the end of Q3, early Q4, I remain bullish. I mean, yes, there's overhead risk. There could be a bigger sized correction coming. I will talk about that in a separate video. For now, I'm bullish. We saw a correction. I'm exposed. I do not see enough reasons to be bearish right here. I do see a lot of potential for continuation or consolidation in markets. For the people who follow me for cryptocurrency, I'm still fully exposed. I still believe we will see altcoin dominance drop. I do really think that both stocks and crypto will soar in the coming months. I mean, the cycle for crypto is also coming to an end. We see new all-time highs for Bitcoin coming very soon. We see strength there. We see Ethereum strength coming back right now as I speak. The Bitcoin dominance has not dropped. It will drop. Believe in it. I mean, it's just something that occurs every cycle. You need patience. The last part is the explosive part where a lot of gains are made in a small period. I do not believe in a huge altcoin cycle. I do think it will be disappointing, but we will see a lot of returns nonetheless. So is profit to be made for altcoins and for crypto in general. So I'm fully exposed in that cycle. I'm 30% invested once again since the lows roughly set back into equities. I still have 70% in cash because I believe that near the year end, there could be some headwinds. And I want to see what happens then before I make an informed decision. But there is still some issues that I see near year end. I will talk about them in time. And I'll talk to you guys some other time. So if you have any questions, let me know. Take care. Bye-bye.